Shane, great to see you again.
Thanks, Brian.
Last time we met on camera, we were talking about the torrid end to 2018, a very turbulent and interesting quarter, and we were trying to calm some of the clients' fears down with your thoughts on what's happening around market volatility, etc.
Yeah.
Pleased to say, here we are, a few months on, we've had a great quarter. Markets have undone a lot of the damage that we saw. All the funds seem to be performing well, markets up. Tell us what's happened.
It was almost a mirror opposite of the last quarter of 2018, where we saw markets drop significantly on the back of Jay Powell's rhetoric, Chairman of the Federal Reserve, saying he's still going to continue to tighten monetary policy, still raise interest rates, still tighten their balance sheet that they raised in quantitative easing. That turned around. So we saw on the 22nd of December Jay Powell come out and negate on his 2 rate rises for 2019, and on Christmas Eve the markets started to recover. Since then we've had a lot more dovish rhetoric from the Federal Reserve, the fact that there's unlikely to be any rate rises in 2019, they've stopped tapering their balance sheet, and the market has seen the safety net come back from the central banks. And what we've seen is the cause of the drop in Q4 last year was the risk of the central bank over tightening interest rates. And typically we've had recessions because of central banks over tightening. Now that risk has gone away, the markets are a little bit more ebullient to push forward. We've also had, don't forget, some kind of agreements on certain disputes. So we had the agreement from the Republicans and Democrats, so the government was reopened after 35 days being shut. It cost $6 billion, government being shut, and it was all down to Trump wanting his wall, which is going to cost about $5.7 billion. So it's evened itself out really. And then we had some sort of agreement between China and US, because going into the end of 2018, the dispute between tariffs between China and US was at its height. The tariffs were going to be raised in January. That's gone away. The 1st of March target has also gone away. So although we haven't got this absolute agreement between China and US, the risk that was going to blow up has dissipated. And of course finally we've got this agreement between the EU and the UK for Brexit. Obviously we don't. That can has been kicked down the road now till Halloween, ironically. That's probably still the biggest unknown out there, but the market can cope with that with trade being ticked off and with the central banks in a more, what's the best way to put it, in a more supportive mood for the markets.
Great, thanks Shane.